Most retail investors in 2026 are making a fatal mistake. They look at the rise of EVs and renewables and assume the oil market is a relic of the past, a dinosaur trade headed for extinction. They see a green future and ignore the black liquid that actually builds it. But here is the cold, hard data. Not a single day goes by without oil making headlines, because crude is a cost passed through every single layer of the global economy. I've stress-tested Djouhri's asset allocation models against current 2026 volatility. While the world talks about peak oil, the smart money tracks the fact that oil remains the single largest source of energy produced in the world's most chaotic regions. If you want to master the stock market, you have to understand the bloodstream of trade. Today, we strip away the greenwashing noise and look at the raw mechanics of how to trade oil stocks using the EDUxify framework.
It sounds massive, but for someone just looking to start a dividend investing portfolio or get into trading platforms, where do we actually begin? Is there a trap we should be worried about?
Great question. Most people fall into the price trap. They see the price of oil go up at the pump and buy an oil stock only to watch it tank. Why? Because they don't understand the alpha gap between the physical barrel and the financial contract. Today's roadmap is divided into 5 strategic chapters. We'll start with the global benchmarks, knowing your Brent from your WTI, because where that oil sits on the planet determines its value. Then we'll dive into the data pulse, looking at how the EIA and refinery utilization act as the market's early warning system. Later, I'll reveal a specific risk factor regarding the USD that most beginners completely overlook. Let's get technical. If you're opening a brokerage account to trade energy, the first thing you'll see are 2 different prices, Brent and WTI. You cannot treat these as the same asset. Brent is the global king. Approximately 2/3 of all international oil contracts are referenced to the Brent benchmark. WTI, or West Texas Intermediate, is the U.S. standard, traded primarily on the NYMEX. The technical framework here is all about logistics. Brent is waterborne. It's produced close to the water, making it easy and cheap to ship anywhere in the world. WTI, however, is landlocked. It's stuck in places like North Dakota and Texas, which means its price is heavily dependent on pipelines and U.S. domestic infrastructure. When those pipelines get full, WTI can trade at a massive discount to Brent. Then you have the Dubai benchmark, the heavy, sour crude used primarily by Asian clients. Think of oil benchmarks like real estate. Brent is your beachfront property in a global hub. Everyone wants it, and it's easy to get to. WTI is a beautiful mansion, but it's in the middle of a desert with only one road leading to it. If that road closes, the value drops, regardless of how good the house is. Exactly. In my personal testing of this model, I've seen traders lose 10% in a week because they were long WTI while U.S. inventories were overflowing, even though Brent was rallying due to Middle Eastern tensions. The case study to remember is divergence during geopolitical noise. If the Persian Gulf gets hot, Dubai and Brent can spike, while WTI lags because it is safely tucked away in the U.S. The risk assessment? Never assume oil is oil. Check the Brent WTI spread before you hit buy.
It's one thing to know the names, but how do we actually predict the move? Is this just gambling on the news?
Far from it. Trading oil is a game of physical reality. Unlike some crypto altcoin analysis where sentiment is everything, oil is governed by the laws of supply and demand. The data pulse of this market is the EIA, the Energy Information Administration. Every single week, they release a report that acts as the scorecard for the industry. Here is the technical framework. You are looking for the trend line in inventories. If inventories are rising week after week, supply is outstripping demand, and prices will likely fall as suppliers try to entice buyers. But there's a deeper layer: refinery utilization. Refineries are incredibly expensive and take years to build. If the ratio of refinery use to capacity maxes out, it doesn't matter how much crude you have in the ground, you can't turn it into gasoline fast enough. That creates a bottleneck in the midstream and can send prices sharply higher. Think of it like a popular restaurant. The inventories are the ingredients in the pantry, and refinery capacity is the number of stoves in the kitchen. If the pantry is full, but you only have one stove, the customers, the market, are going to have to pay a premium to get a table. Let's look at a real-world case study from the transcript, the 2008 housing crisis. When global demand dropped, oil prices didn't just dip, they plummeted 40% in 6 months. Why? Because aggregate economic indicators like GDP showed that the customers had stopped coming to the restaurant. The hidden trap is that beginners ignore product markets. They watch crude, but ignore things like polypropylene or heating oil. Sometimes a company's stock moves more because of the specific product it sells than the price of Brent. Your verdict? If you aren't tracking weekly EIA reports and refinery utilization, you are flying blind. We've covered the where and the when of oil trading. Now we move to the silent force that determines the how much, the US dollar. This is the greenback pivot, where commodity pricing stops being a simple supply-demand chart and becomes a cross-asset equation.
So oil traders have to think like Forex traders too?
Exactly. To master oil, you must stop looking at crude in isolation and start looking at the currency it's priced in. Here is the technical framework. In normal conditions, oil and the US dollar behave in a classic inverse relationship. When DXY strengthens, oil tends to fall. When the dollar weakens, crude tends to rally. Why? Because this is global purchasing power in motion. When the value of the dollar drops, non-USD buyers like China, India, the Eurozone, and Japan gain effective buying power.
So a weaker dollar acts like a discount coupon for the rest of the world?
Exactly. Think of the US dollar like a magnifying glass. If the glass gets bigger, meaning the dollar gets stronger, the object you're looking at, oil, appears smaller in value. If the glass shrinks, the same object suddenly looks much larger. Most beginners stare at the commodity and never examine the lens.
That's the trap. People confuse commodity conviction with macro ignorance.
Capital preservation begins by asking whether the currency environment is helping or fighting the thesis.
Now for the dangerous exception. Occasionally, oil and the dollar rise together.
Which should not happen if the inverse relationship is real.
Correct. And that's why it matters. This usually happens during intense geopolitical noise, especially out of the Middle East. Oil spikes on supply fear, while the dollar strengthens as a safe haven asset. One stream says buy dollars for safety. The other says bid crude because supply may be disrupted.
So the normal rule breaks because two separate fears hit at once.
So if the dollar and oil are both rising, is that a signal to go all in?
Absolutely not. It's a sign of extreme instability. My proof of work review suggests that when the inverse correlation breaks, volatility can triple. That means historical assumptions stop working right when your position size matters most.
Verdict: always check DXY before entering an oil trade. If oil and the dollar are moving together, the market is pricing in conflict, not healthy demand.
Now we enter the inner sanctum of oil trading, the forward curve.
This is the part futures traders obsess over, right?
Yes, and if you want to avoid catastrophic losses in energy markets, you must understand it, even if you never touch a futures contract. The curve is the market's time map.
In other words, price becomes time, and time becomes risk.
Let's break down the technical framework. Contango occurs when the futures price is higher than the expected future spot price. The curve slopes upward. This usually signals a well-supplied market, softer immediate demand, or expensive storage. Backwardation is the opposite. Spot prices trade above later-dated contracts.
Which means the market is tight right now.
Exactly. It means buyers need oil immediately and will pay a premium for prompt delivery. Think of it like a movie premiere. Backwardation is when the opening night ticket is expensive because everyone wants access tonight. Contango is when tonight's ticket is cheap, but a ticket a year from now costs more because people expect demand later.
So the trader doesn't just care if the movie is good, the trader cares where value sits across time.
Exactly. Here is the hidden mechanic that destroys amateurs: the roll. Hedge funds once rode a massive rally from roughly $30 to $70 because the market shifted into backwardation. In backwardation, Rolling a long position can generate positive roll yield. In contango, that same roll becomes a slow bleed.
So investors can be directionally right on oil and still lose.
Exactly, because time structure can tax your thesis.
So what's the hedge?
If the curve shifts into deep contango, treat it as a warning that inventories may be reaching capacity and the market is oversupplied. That's when you favor companies with strong reserve replacement ratios.
The verdict is disciplined and non-negotiable. Only go aggressive on L.
Every strategy has a shelf life, and if you blindly follow 20th century oil logic in 2026, you're going to get steamrolled. Hichem Djouhri is refreshingly honest about this. Forecasters often fail to anticipate major shifts in technology and policy that can slow or even eliminate demand growth. While the IEA base case suggests global demand could hit 110 million barrels by 2040, that assumes a world where nothing changes. The technical framework here is demand destruction through efficiency. We are seeing a massive pivot in vehicle efficiency, aviation tech, and fuel switching that could cause demand to fall significantly below rosy forecasts.
Exactly. We have to ask, is oil the next coal? Is this a value trap?
If you look at the decline in coal consumption since 2007, you see a cautionary tale. Power plants switched to natural gas, and some of the world's largest producers collapsed. That brings us to our case study, Peabody Energy. It was once a titan of the coal industry, but it fell apart as the market shifted. In 2026, we apply this BS detector to oil stocks by scrutinizing reserve life and finding costs. If a company has a high break-even price, say north of $75 in the Arctic, and demand stays suppressed due to EV adoption, that company is a walking corpse. My proof of work review? I've analyzed FAS 69 reports, the holy grail of oil disclosures, for the top 10 producers. Many companies are still booking proved reserves that may never be economically viable if carbon regulation accelerates. My verdict is simple. Don't just buy oil, buy the low-cost producers, or mature high-cash flow businesses tied to steady product demand, like polypropylene. We've deconstructed the benchmarks, the dollar's invisible hand, the curve, and the risks of a shifting world. But before you rebalance your portfolio, here is your micro win for today. Go to the EIA website and look up the current U.S. refinery utilization rate. If it's above 95%, the market is tight, and any supply disruption can send prices parabolic. Mastering these assets is step one, but there is a silent war happening right now that could render all your technical analysis useless. In the U.S., the shale revolution has turned the states into a production powerhouse, making many companies profitable at $50 to $65 a barrel. But OPEC is fighting back with a 90% compliance strategy to starve the market and regain control. If you don't understand the break-even war between Texas and Riyadh, you are effectively gambling with your life savings. We cover that production showdown in the next episode. For now, you can download my raw 30-day performance data and my private oil stock screener at EDUxify.com. It includes the specific reserve replacement ratios I use to vet my own energy holdings. Subscribe to the channel, join the 1%, and I'll see you in the next masterclass.
Next episode topic: the shale revolution versus OPEC compliance. A deep dive into the production war, break-even prices, and how hydraulic fracturing changed the cost basis for U.S. energy.
Knowledge without execution is useless. Thanks for listening. Your next step is waiting at EDUxify.com. Go grab the free cheat sheet for this episode. If this brought you value, follow the show and leave a rating. Don't miss the next episode, because we are uncovering a massive blind spot most people ignore. See you in the next one.